Welcome to the Future of Finance interview. I'm Dominic Hobson, co-founder of Future of Finance. My guests today are Graham Rodford, founder and CEO of Archax, the regulated digital asset exchange, brokerage and custodian based in London, and Brian McNulty, general partner at Lingfeng Capital, a venture capital firm that launched the first tokenised venture fund on the London Stock Exchange digital assets platform this year in partnership with Archax, but also the founder of the funds industry digital investor onboarding platform Token, which is now owned by the Apex Group. Graham, Brian, thank you very much for being with us.
Thanks for having me, Dominic. Pleasure to be here.
Thank you, Dominic.
Brian, I thought we might throw the first question at you. It's a investor question, really. What is the case for investing in this tokenized fund, the Lingfeng Digital Venture Fund?
I think it starts with the strength of the underlying fund investment case itself before we talk about tokenization. And interestingly, still a sort of key thing that's sometimes overlooked in the tokenization space. Lingfeng have got a strong track record. They've already had 6 successful funds. The approach there, the thesis is that they can access proven underlying opportunities through what they refer to as a corridor strategy and move them into other geographies where they've already got them contracts. So they've got a strong reputation. And then when we add the tokenization wrapper around it, which we refer to as the DVF, the Digital Venture Fund. So what we're doing there is by adding that wrapper, that's adding to the use case and allowing broader access, lower minimums, improved transparency, and a clearer route to liquidity on that underlying fund.
Graham, why should investors be interested in buying a tokenized fund?
I think just I guess taking a step back on what tokenization is, it means a lot of things to different people. But from my point of view, I just think of it as a record of ownership. So you can keep a record of ownership on a piece of paper, a spreadsheet, a database, or you can have it on a chain. And when you do it on a chain, then people think of that as tokenization. And when you've got a tokenized asset, it's the same asset as it was before. So if you're investing in the Lingfeng Fund in tokenized form, you're still getting the Lingfeng Fund. So to Brian's point, you still need to lead with the fund, but the fund has extra utility. So if you imagine if you're ever holding a fund investment, you might see your statement, the position sits there, but you usually can't do much with it. Maybe you can subscribe or redeem, but pretty much that's all you can do. Whereas with a tokenized fund, it opens up the potential for more utility. Maybe you can transfer it, maybe you can use it as collateral, maybe there's a secondary market. So what you have is the same asset, but better. So really investors should be interested just because they get the same exposure, but with more utility.
You've explained, Graham, that you get away from this principal-based model where you have to subscribe and redeem with the issuer. There's a secondary market. But investors do still have to subscribe in the first place and might indeed want to redeem with the fund manager at the end of the day if they can't sell it at a price that's attractive in the secondary markets. How does that process of subscription and redemption actually work?
Yeah, you're right. I think with tokenization generally, these kind of worlds of subscription, redemption, and secondary markets are coming together. Subscription and redemption is what I'd think of as primary activity, buying and selling direct from the manager. And historically, you fill in a long subscription document, you commit yourself for a while, and then you're drawn down. And probably that process doesn't necessarily change too much. But however, the world has moved on technologically. So subscriptions and redemptions now can be in the similar form. They can be automated. You can subscribe and redeem through APIs, but also excitingly, you might be able to use stable coins as well. So where we're looking at in the future is a world where you can send in a stable coin and atomically receive shares in a fund, and hopefully in the future you'll be able to redeem out of a fund or redeem in kind as well.
Brian didn't mention this when he talked about the advantages of issuing a fund in tokenized form. He talked about distribution and transparency, but does tokenization improve the operational efficiency with which a fund is run?
I think ultimately it's going to improve everything. I think tokenization improves issuances from the issuer's point of view, infrastructure point of view, and the investors. We talked about the investors. I guess from the issuer's point of view, a lot of people talk about the cost savings. They're not necessarily apparent right now because people are investing in this kind of new way of being. However, it changes a great amount. So being able to see the holder at any point in time using blockchain technology, as I mentioned, it's a record of ownership. When those tokens move around, your cap table is going to be automatically updating with who's receiving it. Being able to use compliance gates, so ERC 3643, one of the token standards, has compliance built into it. A lot of people are talking about this. Being able to check who receives and sends a fund is eligible. Complete transparency. You can have transparency on the holdings. One of the things we've talked about with Lingfeng is tokenizing the underlying holdings in the future and potentially being able to show those in the fund as well. And this kind of verification of all of the assets that are issued at any point in time. So, you end up with it's probably more complicated in the short term. However, in the long term, the amount of synergies and the way that feeds through the industry is going to be a significant saving to an issuer.
Some of the things you talked about there, like record of ownership and compliance checks, are tasks which in a traditional fund would be done by a transfer agent. Now, the transfer agent survives in this particular tokenized structure, which feels counterintuitive in the context of tokenization, which is in its purest form all about disintermediation. Now, is the survival of the transfer agent necessary to perform those functions you've described, like keeping a record of ownership, the transactions, and enabling the issuer, I suppose, to update its view a completely updated cap table? Is the TA surviving here to do those things, or is it really surviving here to maintain interoperability between the tokenized and the traditional forms of the fund? But somebody's got to do that. This fund is going to exist in both forms, isn't it?
I'll maybe answer that. So in practice, yeah, the TA role still matters. We still need some entity to maintain the authoritative investor record and the controls and the operational governance. As Graham said, in due course, it will look very different from the TA function right now. But it's not just about interoperability with traditional formats, it's ensuring that the tokenized structure is still working within the regulated fund operations. So some of the TAs are rapidly advancing their capabilities to be on the front foot of understanding this, even though they've got a foot in both camps of traditional and tokenized, which I think will be the case for a long time. We need that regulated entity to still be there to protect the investors and all the other parties.
Graham, you mentioned transparency. Tokenization improves transparency. Transparency for who?
I guess for the industry at large, it is kind of the quick answer. From an investor point of view, if you think about all of your touch points of a fund, if let's say I'm invested in a venture capital type fund as Lingfeng in the past, I kind of send my money in. And then every now and then I receive a statement for a kind of a liquid fund, maybe on a quarterly basis. Then at some point I might be drawn down. At some point I might start receiving capital back. These kind of are all happening in a vacuum, and you kind of rely on the independence of a fund administrator or someone usually to make sure that the fund's being operated correctly. Now, pretty much every process that I've just mentioned can be put on chain if you'd like it to be. So I mentioned earlier you can tokenize the underlying positions, so you can see a full portfolio on chain. You could tokenize every single cash transaction if you do it with digital stablecoins, and you can even price each of the positions on some sort of oracle if you'd like to. So all of that can culminate, if you like, in a kind of real-time NAV. Now, obviously, someone still needs to verify all of the inputs into that, but it's helps the investor hugely if they're able to look into a fund and see what's going on. And the reason I mention the industry at large is I think just generally alternatives are kind of a bit of an opaque industry really when it comes to investors. It's in the past at least it's been kind of fund of funds, institutions, pension funds that kind of invest into this space, and usually there's some dedicated journals about investing in alternatives, maybe some indices, but it isn't very transparent. Whereas especially if these are on public blockchain, imagine in the future that you've got all the alternatives out there producing all of their information on chain, and suddenly you have transparency of an industry and some good comparables that you just wouldn't get with the headline data today.
that tokenization of the underlying, which you refer to, that's not happening here. This is part of your future vision of the benefits of tokenization, the great increase in transparency. I'm right to think that, aren't I?
We've discussed it. It probably is something we're looking at, and we're open to it still in the fund. I mean, ultimately, all funds will move in this direction. I think most people across tokenization right now are tokenizing at the fund level, but where this gets really exciting is where you tokenize at the underlying level, because that means you can real-time price the NAV of your fund, but you can also do things like redeeming kind, transfer underlying positions between vintages. These are all things the Lingfeng team have been exploring and just deciding the best process to go live with. But yeah, it's not something that we're necessarily implementing now, but it's something we definitely believe is the future.
A nice workshop on that to look forward to on Wednesday, Graham.
Exactly.
Okay, let's talk about the benefits for the issuers. Brian, you touched on this at the outset, but has tokenizing this fund actually widened the distribution net for Lingfeng? Are you reaching new types of investors with this structure?
Yeah, I think let's just come back on a few points there. I think it's exciting enough tokenizing at the fund level. I think, as Graham said, we want to explore further benefits to end investors. But I mean, many of us, their patronage has put us off investing in the VC world. You put your money in, maybe in 5 years plus you get something back. So the liquidity that we're driving here to give the opportunity to buy and sell on a quarterly basis is already transforming the VC model. So that is attracting new investors. But adding on top of that, because we've tokenized with Archax, the DVF allows you to come in a much lower minimum. So rather than our traditional funds being X 100,000 to come in, you can come in a much smaller amount. So we're allowing broader range of investors, appropriate investors, to come in that would otherwise be excluded, and allowing them to have liquidity. So this is transformational, Dominic. This is venture capital 3.0 before we look at tokenizing the underlying.
And Graham, those new investors which Lingfeng are reaching with this structure, traditional funds are distributed, they're sold, they're not bought, as it were, by retail investors using apps on their phones or whatever. So has tokenizing the fund also brought into play a new class of fund distributor as well as a new class of investor?
Yeah, I mean, yes is the quick answer. I guess Archax is arguably one of them. We are a regulated broker exchange custodian. In the past, most brokerages don't tend to sell funds in this way. However, we are. One of the things that we're doing is combining, to Brian's point, a nominee company with our brokerage, which means we can take positions in funds via our nominee, and then distribute them out ideally at below a minimum amount. There's a few people doing that. In conversations with LSEG, there's obviously other nominees joining in there as well, all of which will improve access to funds such as these. But I think moreover, across the digitization of financial markets, what we're seeing is that, in fact, not even just this tokenization, but just generally the shift in financial markets. You've got this world where two things are happening. I think bank accounts are merging with neobanks, are merging with wallets. All of these things are kind of becoming the same thing. And at the same time, you've got this complete shift in people's attention. So nowadays, people don't want to spend ages filling out a subscription document. They want to go somewhere and just click quickly. And so all of the user experiences are built towards that. So a lot of these neobanks nowadays are kind of looking for these kind of fast ways to access capital and access new types of instruments as well. So I just think the mindset has changed that everyone should be able to invest in everything. And at the same point, structurally, companies like ours are changing those distribution models.
Do you think, Graham, this is part of a large underlying shift back to retail investment, to retail investors getting involved, away from this intermediation by institutions? Do you think there's something bigger happening here? I mean, we're seeing stock exchanges start to build retail business again.
I think crypto and trading has been interesting for the last 10, 15 years. I think cryptocurrency trading, now this is nothing to do with crypto, but it has brought about a lot of people that are more interested in financial markets than they were before and are performing analysis like they never have before. And at the same point, you had a bunch of crypto exchanges launched that were your exchange, custodian, broker, front ends, everything all in one. If you think about, like a typical exchange like London Stock Exchange or NASDAQ of the past, they typically are just the exchange. But those distribution models are pretty difficult now because you require the whole financial market infrastructure. It's why you've seen NASDAQ, NYSE do deals with cryptocurrency venues later, because they realize that you need to be much closer to your consumer, which, to your point, you can kind of think about as retail. So I think there's just I think people are more cost aware. We're in the age of AI, we're at the age of data. You've got access to the full price of everything. Retail is supposed to be the most protected, but usually pays the most layers of intermediated fees. So I still think there's a space for specialist intermediaries, but I also think there's a lot of people that want to go trade directly and have the capability to do so, and so they should be allowed to.
But even these intermediaries, including even pension funds, are coming on a little bit more pressure to have an exposure to the digital asset space. So something like DVF and other funds that hopefully follow suit. This is a much safer and less risky way of ticking that box of digital assets in your portfolio without actually creeping into the more risky purchasing of EG coins, etc.
Mhm. And Brian, on that point of this becoming a less risky way of increasing your exposure to digital assets, has tokenizing this one fund increased interest in other funds that are managed by Lingfeng?
A small amount, yes. We've had some parties that have engaged us on this and then realised the strength of Lingfeng and started getting involved in Lingfeng secondary funds or the Middle East fund, for example. But it comes as a sort of double-edged sword, as we're beginning to realise, because some investors that we would normally not be talking about tokenisation at all, it was quite a straightforward conversation with them, and we were quite confident that they were going to invest. Now, when they want to know more about the DVF, those straightforward conversations are becoming quite elongated, and we're still finding our feet a little bit here, that we may well have introduced a risk in some of those discussions.
Mhm. Graham, you've touched on this already, but benefits for investors. You've talked about a secondary market developing and actually sell the fund as opposed to give it back to the issuer. This fund is being listed on the LSEG Digital Markets Infrastructure platform. I'm going to use the word liquidity here, by which I mean not just the ability to sell something, but the ability actually to reach those investors you were talking about earlier, the retail investors who've grown up in a cryptocurrency environment, who don't want to fill in a subscription form, goodness knows, perhaps attach a check to it and mail it to a TA. Is tokenization already starting to increase liquidity in that sense? Not just creating a secondary market, but actually creating a secondary market populated by a new generation of investors?
So the quick answer is yes, I think, but for both points you mentioned. So if we talk about the first, historically, you would very rarely find an alternatives fund with a secondary market. And I don't think, Brian or I are saying if you create a secondary market, this thing's going to trade 10,000 times a second. I think what you're doing is removing obstacles. So there's a lot of institutions out there, pension funds, endowments, who might well like what Lingfeng's having to offer. But if you tell them, look, it's going to be investing for 3 to 5 years and paying back over two, they might just say it's a bit outside our risk appetite. If you follow up with that and say, however, the investment manager can always buy back, at a 2% discount. There's a secondary market operating on Archax, and by the way, you might be able to redeem in kind the underlying. Suddenly, you're breaking down those barriers, and the way I like to think about it is you're facilitating liquidity. Before there was no option, at least now there's an option, and probably you can get out, but it's just the price you'll get out at, which is all about making markets. I think that's true. And then to your other point, I agree as well. These people want access to products, and so you're right to think of liquidity in that way as well. There's an amount of capital that gets allocated to these types of funds, and with everything going on in digital, we're now finding that there's blockchain foundations that have capital. There's DeFi protocols that have capital. There's people investing in digital that want to be earn products or saving products where the underlying can be invested in something like Lingfeng. So I think, the kind of the base of investors is I guess increasing that kind of foundational availability of liquidity, and then above that you've got the potential to facilitate secondary market trading as well.
You used the word obstacle a minute ago, and the obstacle you alluded to was people interpreting, or investors interpreting, this new instrument through a conventional lens. And it's when you explain to them what's different about it and what the unique advantages are that the conversation starts to change. What other obstacles are there to getting a fund tokenized and distributed to investors?
Well, I guess these things will start with knowledge. So there's two main ways you can tokenize a fund, just I guess for everyone's benefit. One is that you create a tokenized fund from the outset, so which means the legal books and records sit on a blockchain. The other way, which is the most common way, is where someone like Archax invests in the traditional, and then you create a tokenized representation. So, the first obstacle is really understanding those two different paths, making sure that you're allowed to do it legally within which jurisdiction you're based, and then picking it. And usually with institutions, there's a journey to go on. You have to not only work with the team that are kind of the innovation unit usually, but you then need to work with the compliance team, the legal team, the risk team, and take them on the journey. So I think there's just a bit of an understanding. The second point is regulations. Just if you're distributing a digital product, making sure that the people that you're speaking to are capable of distributing digital versions of the products. And then I guess Brian will know more of this than I, but distributing it as well. You're already going and saying, "Hey, here's a product. We'd like you to understand our track record and what we're doing." And now you've got this additional piece of tokenization as well. And like Brian said right at the outset, and I can't emphasize it enough, you still have to sell a product based on the product's merits. Really, the fact it's tokenized should be just an infrastructure point with some additional utility benefits. The team should still be out selling the fund.
Brian, do you want to pick up that challenge from Graham? You'll know more about how this impacts fund distributors. Are they struggling with knowledge, with technology, with processes to absorb tokenized funds, or are they finding it relatively straightforward?
I think there's a full spectrum there. There's some that are this is a main focus, and there are others that are trying to play catch up without actually having the team with the knowledge to catch up. So I would say that there's many popping up. I think from our point of view, I've been in this space now for 10 years this month, actually, since we set up the post-trade distributed ledger group. And I think we are deliberately focusing on knowledgeable counterparties. Like, we're all learning still, but we don't want to be in the at this stage of trying to, if you like, educate. We need to be all clear as much as we can be at this stage on the rules for fund setup, fund issuance, fund distribution within the different jurisdictions from the point of view of it being a tokenized fund, which we are. So I think filtering the right participants reduces the friction and increases the chance of successful adoption. I'm not going to just say it's because Graham's here. That's why Archax are critical. I mean, Archax are the market-leading regulated digital issuance, custody and trading. And I will say those things for that exact point. Is less parties, and it means that they're regulated and they've got a track record and they've been through the same long journey that we've been through. So by bringing together Archax and the DMI and having a forward-thinking TA, even though we're only using the TA for traditional services, is enough for us to give that. There's benefits that we talked about earlier. There's nothing else for us to do. We're ready, and we're also open. If other VCs or other funds want to find out what we've done to replicate it, no problem. Just get in touch.
Graham, when it comes to tokenizing funds, tokenization enthusiasts have focused on alternative funds for obvious reasons, such as the minimum subscription amounts have meant that those asset classes like private equity have been reserved really for big institutional funds. Does it remain the case, given everything that we've been talking about, mean that the fund tokenization industry must continue to concentrate on alternative funds for now, or must it continue to concentrate on tokenizing alternative funds forever?
Well, I think technology will always improve, but certainly every single fund manager across the world needs to be thinking of this now. I think, Brian mentioned he's been in the space for 10 years. Archax set up 8 years ago. We've both been talking about the tokenization of these asset classes for that entire period of time. And the last 24 months is where it's really started to take off. You've got Larry Fink from BlackRock, Jamie Dimon, and JP Morgan saying this technology makes much more sense than anything before. And I think it's not just the tokenization, of course, of the asset; it's also the tokenization of cash alongside it. That now you've got cash and asset on the same technology. So delivery versus payment, corporate actions, subscriptions, redemptions, whatever it might be. All of these processes are fundamentally easier. And if you want to appeal to this new distribution of investors we're talking about, then you really need to have your tokenized assets available. So Archax probably, and certainly not our peers. I suspect between all of us, we have the top 50 to 100 asset managers talking to us or working with us on tokenization. And even beyond that, most of the kind of the asset management groups, if you like, all of their members are interested in this as well. So this isn't going anywhere. I think what's interesting about this as well is that everyone thought the illiquids would be the first thing that was tokenized. There was a lot of real estate and private capital funds discussions about 10 years ago. They kind of gave way a little bit to stable coins and money market funds. But now everyone's gone, okay, we've now solved kind of the kind of velocity of capital and cash and yield bearing instruments. What can we now do for the illiquids? And I think tokenizing illiquids before wasn't as exciting as it should have been because this utility wasn't being built, but now people are starting to build that utility. The idea that you might be able to use a Lingfeng fund as a collateral is absolutely, within everyone's grasp now. So I think, I think this time there'll be no slowing down. I think you'll see nothing but an increased number of tokenized funds coming over the next year or two.
Mm-hmm. So, Graham, you're confident, just a last question for you, you're confident this model can be scaled?
The model will be scaled. I mean, I am a big believer that every single asset class is moving on chain, and I think if you're not an asset manager moving your assets on chain, then you're going to be disrupted. Everyone wants everything accessible. I mean, especially with AI now, everything needs to be available digital over APIs and connected in. And a traditional fund in an analog way with a sub-red document that's not transferable just isn't going to interest the people of the future. And I think all the sensible asset managers recognize that.
Brian, last word from you. What happens next at Lingfeng?
Well, at Lingfeng fund level, we want DVF to attract more investors and to validate this commercially. I think, come back to what Graham was saying there, I want to facilitate liquidity across the market. If we sort of just look broader than that, we want to see more funds adopt this model and build the momentum that we've all touched about there in VC 3.0. And beyond that, as we doubling back what we said earlier on, Graham and I and our teams believe that there's a lot more benefit we can offer investors by looking at tokenizing the underlying. So that'll be the next focal point.
Graham Rodford, founder and CEO of Archax, Brian McNulty, general partner at Lingfeng Capital. Thanks very much for taking the time to share your knowledge and your insights with the members of Future of Finance.
Thanks for having us, Dominic.
Thank you, Dominic.